In this video, I'm going to cover the review questions for the final exam. And you can find a PDF of this OneNote document on Canvas. And so I recommend you go through the problems yourself first, and then come back and then see the solutions. And remember, the final exam, it's going to cover the chapter on Black-Scholes and then on forwards and futures. So let's get started with this. And one thing to note on Black-Scholes, I've been asked by a few people about this. Black-Scholes, the formula involves things like the cumulative distribution of the standard normal and things like that, which most people are not going to have on their calculator. So you won't have ones that will ask you to do that specific calculation, but you might have ones that are more conceptual, or ones that do have some sort of calculations either with the Greeks or some that are possible on a calculator. So anyway, just note that. Okay, so make sure you're also familiar with all the conceptual side of Black-Scholes. All right, let's start through these then. Black-Scholes basics. So I sort of have a label as we go through of what these problems are covering. Let's look at the first one. Which of the following variables in the Black-Scholes option pricing model is the most difficult to obtain? Volatility, the risk-free rate, the stock price, time to expiration, or the exercise price. And of course, the answer here is the volatility. That is the only one that's not given to you that you can't just look up, that you're going to have to estimate. All right, let's look at the next question. If one wants to use the Black-Scholes formula to price an option, which of the following must be known? The stock's expected return, the stock's standard deviation of return, whether the stock pays a dividend prior to expiration, or both B and C. And the answer here is D, both B and C. Okay, and why is that? So let's look at the first one. Let's go one by one here. The stock's expected return. Do you need to know that? No, you do not need to know the expected return. Okay, you don't need to know whether the stock is going up or down. That actually doesn't matter to the valuation of Black-Scholes. What does that mean? That means if you have two stocks and they're the same in every other way, except one has a positive expected return, maybe 20%. The other one you expect to go down by 20%. The value of options on those will be exactly the same. Okay, so that's an interesting thing. All right, let's look at the other parts. The stock standard deviation of return. What is this? This is what we call the volatility. And that we do need to know. So that's yes. And whether the stock pays a dividend prior to expiration or not, that is yes also. If it pays a dividend prior to expiration, what we do is we substitute for that initial price. We're going to substitute in that the current price of the stock minus the present value of any dividends. That's our notion that we've been talking about, that dividends are like a rebate to the price. So B and C is the answer here. All right, let's keep moving on. Things related to Black-Scholes. Implied volatility. All right, know what implied volatility is. The implied volatility is obtained by finding the standard deviation that, when used in the Black-Scholes, this is sometimes called the Black-Scholes-Merton model. Hopefully I won't confuse you with that on the exam, but when used in the Black-Scholes model, makes the price which of the following? So when we say model price, we're talking about the Black-Scholes model. Makes the model price expire at 0. Makes the model price equal to the market price of the option. Makes the model price such that it exceeds the currently traded market option values. Makes the model price equal to the intrinsic value of the underlying stock, or none of the above. Implied volatility is this one right here. Okay, so implied volatility is the value of volatility. That is the value sigma, that when you plug it into the Black-Scholes formula, makes the value you get from the Black-Scholes formula, that is the model price, equal to whatever you see in the market. It's sort of what the market is using in the Black-Scholes model. All right, so that's implied volatility. Know that. And why are these important? These are important because of the answer to the first question. Volatility is the one thing it's most difficult to obtain. So these are the two standard ways that people will get it. Number one, implied volatility. Number two, let's talk about historical volatility. What is meant by that? The historical volatility of a stock is calculated by what? Finding the value of volatility that makes the Black-Scholes formula equal to the market value of an option. B, using historical data to statistically estimate the standard deviation of a stock's return. C, measure the difference between the high and low of a stock over the past year. Or D, using analyst estimates for the future value of a stock. Historical volatility. Remember, volatility is another name for standard deviation, and that's just using historical data to estimate the standard deviation or the volatility of a stock. Okay, so make sure you know the distinction between implied volatility and historical volatility. All right, next we're going to head in and talk about, these were called the Greeks. Know your Greeks. Know which Greek corresponds to what parameter. So let's go do some problems in the Greeks. And here I'm telling you, this one's about delta, theta, vega. I might not tell you that in a problem on the exam. I might give you a couple of the Greeks, and you've got to pull out the correct one. Okay. So anyway, consider a European option with a delta of minus 0.4371. So this is a put option. If the underlying stock price increases by 50 cents, by how much is the price of the put option expected to change? And I have here, make sure to get the sign of the change correct. All right, so here's the formula that we always use. I tried to emphasize this in the lecture. We have change in, and this is in the option price. I'm just going to say change in price. It's a put here. Is always approximately whatever the Greek is, so delta times the change in whichever parameter it refers to. So in this case, change in stock price, because delta is the first derivative with respect to stock price. So what do we get here? Delta is 0.4371. I better put that minus sign in front of it because it's minus 0.4371. And then what is the change in the stock price going up by 50 cents? We're just going to multiply those together. And I'm going to get minus 0.2186. So this would be the expected change in the price of the option. All right, so that's delta. Let's move on to the next one, theta. Consider an option with a theta of minus 14.3 if a week passes by and the underlying stock price doesn't change, nor does any of the other parameters. By how much, that should be a do, not a to, by how much do you expect the price of the option to have changed? Make sure to get the sign correct. An increase in the price should be positive and a decrease should be negative. Use 1 over 52 to represent a week in years, okay? So when I'm giving you theta here, I'm always measuring time in years. And I'll measure also volatility as a decimal, not as a percent. All right, again, the formula is always the same. So change in price of the option, okay, is going to be approximately theta times, now what is theta with respect to? Theta is the sensitivity with respect to time. So just make sure you know this pattern. If you know this pattern, then you're going to get these problems correct. Well, you not only have to know the pattern, you also have to know which one corresponds to what. Okay, so theta starts with, this is the way I remember some of these, can't do it for all, but theta starts with a t, so it's with respect to time. Okay, so the theta here was minus 14.3, and then time, how much time has passed? We're going to measure time in years. So a week is 1/52nd of a year. And so if I did my math correct, that's minus 0.275. So what does that mean? That means in a week, I would expect the value of the option to have dropped by about 27.5 cents. So I could ask a question where I don't tell you directly to use theta, but say something like everything else has stayed the same for an option. A week has gone by. How much less valuable do you expect the option to be, or how much do you expect the price to have changed? All right, let's go down to the next one. Let's go down to Vega. The Vega of an option is 19.7. If the volatility increases from 30% to 32%, by how much do you expect the option price to change? Okay, same pattern. Same pattern. Change in price is approximately Vega. No, there's no Greek letter here. They just made it sound like a Greek letter. Times change in what? Vega is with respect to volatility, which sometimes is abbreviated vol. Okay, so let's do this one. So the Vega of this option is 19.7, and when I'm giving you Vega, I'm going to use these values here as a decimal, not as a percent. So it's gone up by how much? 2%. So it ended at 0.32 and it started at 0.3. So I want you to do that as a decimal. Okay, because this calculation was done as a decimal. All right, and so here you're going to get 0.394. So this tells you that if volatility increases by 2%, you're going to expect this option's value to increase by about 39 cents. Okay, let's go to Rho. Rho starts with an R, so that's going to be with respect to interest rates. All right. If the risk-free rate decreases by 1%, and again, the way we defined the Greeks, we're going to use decimal numbers. Okay, so watch out for that. That 1% we should write as 0.01. Okay, don't write it as 1, but 0.01. The risk-free rate decreases by 1% and the price of an option increases by 0.05. Then estimate Rho of this option. Okay, this is a little bit of a twist. So let's go and let me remind you of what the definition of Rho was. So if we go back to our derivatives, it was dc dr, and so what is this? This essentially leads to the formula that we had, and I'm trying to justify the calculation that I'm going to do here, but let's go back to our basic formula. Change in price is approximately Rho times, and Rho starts with an R, so it's change in interest rate. And the interest rate here is that continuously compounded annualized interest rate. So this is the formula that I'm going to use, and I want to calculate Rho. So let's solve for Rho. So Rho here is, I'm just solving for Rho. Change in price divided by change in that risk-free rate. So this is a way that I don't know that I did this in class, but I'm just rearranging the basic formula. And actually, you should connect that with this formula here, if you remember your calculus. These are essentially similar formulas. Anyway, you don't have to do that. But I just solved this formula. So what was the change in price? The price increased by 5 cents. And what was the change in the interest rate? It decreased by 1%, and I'm doing that again as a decimal number, not as a percent. So you do this, and I'm going to get minus 5. So this would be my estimate for Rho. Okay, so be prepared to do all those calculations, or just to be given a scenario. Here I basically told you, which Greek to use. I might just give you a scenario and say something happens, and you've got to pull out the correct Greek to use. All right, let's take a look at this last one. The options delta is approximately the change in the option price for a change in the stock price. That is true. That's exactly what it is. Okay, so if we go look at delta again, let's go up here. And if I take this and I were to solve for delta, then what do I have? Solve for delta. I have change in price divided by the change in the stock price. And so that's exactly what delta is. If somebody gives me a delta like this, my interpretation is, so it's minus 0.4, let's round it, minus 0.44. Then this tells me for every dollar that the underlying stock moves, the price of my option will move down. So if the stock goes up, the value of my option will go down by approximately 44 cents. So that's exactly what it is. Change in the option price for a change in the stock price. Okay, so know that too. That's sort of the interpretation of it. All right, I think the rest of the problems down here have to deal with forwards and futures. So let's start into these. So the first one here goes to a definition that I had in the final lecture that I posted. So contango. A contango market means what? Futures and forward prices are equal. Futures prices exceed spot prices. Futures prices are below spot prices. All of the above and none of the above. Okay, so let me remind you of the definitions here. If we look at time to expiration, okay, and we look at futures prices as a function of that time to expiration, capital T. If there's no time to expiration, the futures price is equal to the spot price. And so we look at futures prices relative to that at different times to expiration. And if they are above, then this is called contango. Okay, so that is futures prices exceed spot prices. What about futures prices are below? When futures prices are below, this we called backwardation. Okay, funny names, but that's terminology that you find in futures. All right, so know that, know that terminology. Let's do some calculation problems. Suppose you buy a 1-year forward contract at $65. So this is the forward price. When it says you buy it at $65, that's the forward price. At expiration, the spot price is 73. The risk-free rate is 10%. What is the value of the contract at expiration? Okay, this one is throwing you off a little bit because we're at expiration. So let's go back to our formula. And so if you look in your slides, you're going to have a formula for the value of a contract. Okay, and this is the time t value of a contract. And the formula was you take the current price of the underlying, and I'm not incorporating any dividends into this. And then what do? We subtract off the present value of the forward price. Okay, and that difference was the value of the forward contract. What do we have here? Here we're going to have little t is actually at expiration. Okay, that's actually going to simplify things. And this is the present value at a time little t. So this is capital T is the same as, little t is the same as time capital T. So what do I take? I take the final value of the stock price, that was $73, and I subtract off the present value, but the time t present value of the futures price. Okay, but everything is at time capital T. So for example, our formula up here was S sub t, just to be explicit about it. And then when I calculated the present value, it was 1 plus r to the capital T minus little t. Okay, so I'm going to plug in these values, but I see here that little t is actually the same as capital T, and so this whole bottom is just going to disappear. So we're just going to get, oops, sorry, one note went a little crazy on me there. So I'm just going to get S sub t minus the forward price. So what is that? 73 minus 65, or $8. Okay. Let's do some others on forward. So forwards and futures, there's some conceptual stuff, but there's also calculations that you can do. So be prepared for these basic calculations and know the formulas. Suppose that you buy a forward contract at $40. So this is the forward price with expiration in 6 months. After 3 months, the underlying asset has a spot price of 35. The risk-free rate is 3%. Assume that the underlying asset does not pay a dividend. What is the value of the forward contract at 3 months? Okay, so this one, the one up above was at expiration. This one is not at expiration. So again, our formula was VT at little t. Remember, little t is where I'm sitting right now. Capital T, so this is the 3 months. Okay, and capital T is the 6 months. Okay, and our formula was I take the current price of the underlying. I don't need to subtract off any dividends, right, because we said there were no dividends. And then the formula is I take the present value of that forward price. So this is going to be 1 plus r to the t minus t. And we're just going to plug into this. So the current price of the stock is 35. The forward price is $40, but now I need to discount that back. The risk-free rate is 3%. And what is capital T minus little t? Well, capital T is 6 months, little t is 3 months, so I got to go back 3 months. That's a quarter of a year. Okay, so I'm going to do that, and what do I get? Minus 4.71. Okay, so I actually get that the forward contract has a negative value. You can do a sanity check, right? When you do these problems on the exam, you might want to just do a sanity check on the sign. This one, my forward contract locks me in at this price, right? That's what it does. So I have to pay $40. 3 months go by, and I look at the spot price, and the price has gone down. So I'm locked in at $40. But you know what? If I weren't locked in, I could go and I could actually buy the asset right now for 35. So this forward contract is essentially a liability because it locks me in at a higher price. That's why it has a negative value. Okay, let's keep going here. A futures curve in which futures prices are below the spot price is said to be in, okay, we already talked about this. Below the spot price, that was called backwardation. Okay, I like the funny names that they use there. All right, next thing, mark to market. As soon as a futures contract is marked to market, its value is 0. Let's remember what the mark to market mechanism is. Mark to market is exactly this notion that at the end of every day, they will settle accounts and adjust the futures price so that the value of the contract is 0. That's in fact exactly what they do. So that is true. And that is the main difference between a forward contract and a futures contract, is the marking to market. Let's go a little bit further into the marking to market. If you're short 2 futures contracts, so I'm short 2 futures contracts, and the futures price increases by $2. By the way, if you are long a futures contract or a forward contract, you are the one who is agreeing to buy the asset. If you are short, you are agreeing to deliver the asset and receive the price. Okay? So here we're short, but the futures price increases by $2 during the day. When the contracts are marked to market, by how much will your account change? All right, the simple mechanism for marking to market is, and I put this formula, take the number of futures that you have, and then it's the futures price today minus the futures price yesterday. Okay, so pretty simple. Here we have minus 2 contracts because we're short. And then how much did the price change by? So it changed by $2 during the day. So that's a positive 2, it went up. So you will lose $4. When they mark it to market at the end of the day, your account will change by $4. They'll take $4 out of your account. Okay, Just remember this formula and it's pretty straightforward. Let's move on to pricing of futures. Consider a futures contract on an underlying asset. Assume the spot price is $50 and the asset pays a dividend of $1 in 3 months and $1 in 6 months. The risk-free rate is 2%. What is the futures price for expiration in 6 months? Assume that expiration is just after the payment of the dividend in 6 months. Okay, so here it's pricing a futures contract on an underlying that pays a dividend. And what was the formula there? So I'm going to assume I'm sitting at time 0 right now, and I want that futures price for 6 months. And our formula was, now that we have dividends here, I'm going to take the spot price, but I'm going to subtract off the present value of any dividends. And then what do? I compound that out to expiration. Okay, so that's my formula. So I'm just going to plug into this. I just need to do the calculations here. So spot price is $50, and then I need to subtract off the present value of all these dividends. So I've got a dividend of $1, and that occurs in 3 months, so I need to calculate the present value of that. I'm going to discount that back. 1.02, and that goes through a quarter of a year because that's 3 months. And then I've got another dividend of $1. That's out at 6 months. 1.02 to a half year. I got to discount that back a half year. All right, and then I take the whole thing and I actually compound it out to expiration. So that's 1.02, and expiration is in 6 months, and I compound it out. Okay, so just to be clear, this part here is the present value of the dividends, and then this here is, compounding it out to expiration. And so you do this, you're going to get $48.49. Okay, pretty straightforward application of the futures pricing formula. Let's move on to the next problem. Consider an asset with a current price of $40. So that's the current price. Assume it pays a dividend of an amount D in 3 months and another dividend of the same amount D in 6 months. If the 6-month futures price immediately following the second dividend is $39.59 and the risk-free rate compounded annually is 3%, what is the dividend amount? This is just like the problem we did up above here, but what I don't know is the dividend now. So let's go back to the formula again. So the formula is, I'm going to take S0 minus the present value of all those dividends, and then that gets compounded out 1 plus r to the t. So that was our formula. So let's see what I know. I know this futures price, so I'm going to begin to plug things in here. 39.59. Okay, and that's equal to, what is the spot price? That's 40. Now here's what I don't know. I don't know the present value of the dividend amounts. So the dividend amount was called D, and there's one in 3 months and one in 6 months. So I have D over, this is the 3 month, I need to calculate the present value of that. The risk-free rate in this case was, what was it, 3%? So this is 1.03, and that's a quarter of a year. Plus there's another dividend out at 6 months, 1.03 to the 1/2. Okay, and then all of this gets compounded out to expiration, which is half a year. Once I've done this, I need to solve this equation. So by the way, here when I'm doing the problems, they're not multiple choice. You would have to solve it. If you get to a situation like this on the exam and you say, I'm not good at solving this kind of equation, I might make a mistake, then instead take some of the answers and just plug them in for D and see which one, and do the calculation, see which one is going to satisfy the equation. Okay, but in any case, here I'll show you how to do this this basic equation. So I'm going to move this to the other side, and I'm going to factor out a D. So I'm going to go through the solving here. Hopefully I have enough room. So I divided it here by 1.03 to the 1/2, and that's going to equal 40 minus, and then I'm going to put D, and then I just factored out the D. 1.03 to the 1/4 plus 1 over 1.03 to the 1/2. That's what I have right there. And so let's see, I'm going to move things to the other side. So let me take another step here. So I'm going to move the factor with the d over to the left-hand side. I don't like having to write all this again, but I'll do it quickly. So I'm just rearranging this equation. Okay, and then on the other side, I'm going to have the 40 minus, did I calculate that value? No, I haven't calculated it. 40 minus 3959 over 1.03 to the 1/2. And then I would divide both sides by this amount. Okay, and if you did all those calculations, and I'm sorry I'm not showing all the details here, but I divide both sides by this amount here. First I can just plug this into my calculator, get a number, and then I can calculate this quantity here, and then I divide by that. And if you do that, and I'm just telling you the final answer here, 0.50. So again, this might be a tricky calculation on an exam. Multiple choice, take some of the values for D, plug them in, see which one it satisfies. All right, let's move on to another one. We have another problem on futures pricing. So consider an index with current price of $80. The index pays a dividend. The annual risk-free rate is 6%. If the futures contract expires in 6 months and the cumulative value of the dividend at expiration is $1, what is the absence of arbitrage futures price? Okay. Very similar to the ones up above, we're going to go to the same formula. And we know that our formula is the futures price is equal to the spot price minus the present value of any dividends. So that's if we have dividends, and here we do. And then all we do is we compound that out to expiration. Okay, and here the only thing to note is that they don't tell us when all the dividends are, but they tell us the cumulative value of the dividends at expiration is $1. So we're going to take the dividends to be $1 at expiration, and then we can solve this problem. So current value of the index price is 80, minus, I'm going to take that $1, the cumulative dividend, and I'm going to discount it back 1.06, discount it back a half a year, because that was at expiration, and expiration was 6 months, and then I multiply this by 1.06 to the half a year. And I just plug that in, and I'm going to get $81 and 36.5 cents. All right, let's move on to the next problem. The next problem is about the arbitrage strategies. So cash and carry versus reverse cash and carry. So the spot price of an asset is $38. The futures price for expiration in 6 months is $30, and the risk-free rate is 3%. Assume the asset does not pay a dividend yield or have a cost of carry. What arbitrage is possible, and what would the arbitrage profit be? So here you need to be able to determine what kind of arbitrage, cash and carry or reverse cash and carry, and then what would be the profit of this. So we start out here, we've got a futures price for 6 months. I'm going to call that the market price, and that's $30. And then I've got the spot price, and what we do is we compare the futures price in the market to the model price, which would say that the futures price which would say that the futures price should be the current price of the asset. There's no dividend or anything here, just compounded out to expiration. So let's calculate that. This is our model price. So $38. The risk-free rate is 3%, and we're going to do it 6 months or a half a year. and this is going to give us a value of 38.57. Okay, so here's our market price. So this is in the market. And so we can see that the futures contract appears to be underpriced in the market, right, relative to the model. So what do we have here? We have the market price is less than S0 1 plus R to the T. If we had dividends here, we just plug the dividends, the way we normally do, subtract off the present value of the dividends, we compare it to that. So because of this, what do we want to do? We always want to buy what's cheap, so we're going to buy the futures contract, and that means we're going to sell the asset in the spot or the cash market. So what is this? This is reverse cash and carry. So make sure you have the distinction between those written down in your notes, between cash and carry and reverse cash and carry. And what is our profit on this? And your profit is always just going to be the difference between our absence of arbitrage price and the price you see in the market. So it's going to be the $38.57 minus the $30, or it's going to be $8.57 at expiration. Okay, so make sure you know cash and carry and reverse cash and carry. All right, one final problem here. General formula for futures prices in terms of a carry, whether it's a positive carry or a cost of carry. So let's do that. So you're trying to calculate the absence of arbitrage futures price of an asset whose current spot price is $50. Assume the risk-free rate is 3%. You're interested in the futures price for expiration in 1 year. For this asset, it has a storage cost per year, paid at the end of each year, of $2. It also pays a dividend of $1 every 6 months, including immediately prior to expiration. So if you hold the asset, you will receive a dividend of $1 in 6 months and $1 at 1 year. What should be its futures price for expiration in 1 year? Now for this, I'm going to go to that final general formula that defines the futures price. So it's going to be F0 of T, and we said, what is that? Well, it turns out you need to calculate the future value of three things. The future value of the spot price of the asset, so that's a cost. The future value of any cost of carry, in this case it's a storage cost. And when I say future value here, it's the future value at expiration, minus any sort of rebates that we have, and that is the future value of the dividends. So let's do those calculations. So the current price is 50. I'm going to need to compound that out over a full year, so I just multiply it by 1.03. The storage cost occurs at the end of each year, so I don't need, it's already at the end of the year. So that's just going to be a $2 minus, and then the future value of any dividends. Well, there are two dividends, one at 6 months. So there's $1 at 6 months, and I need to compound that out to the end of the year. So that's going to be compounded out a half a year, plus the dividend at expiration. I'm going to do this calculation, and what do I get? And I'll show you a picture of this before we wrap up. And I get $51 and 48, rounded up to 49 cents. The picture of this, if you wanted to draw a picture, here's a cash flow diagram. Here was time 0, ended up paying $50 here. At expiration of a year, let's do half year. Expiration of a year, you have to pay $2 in storage cost. You got a $1 dividend here, $1 dividend here, and essentially all we did was we calculated the future value of all these things. And any negative one is a price, any positive one is like a rebate, and that future value gave us that. And that's the general concept that we should add on any negative carry, that is any cost of carrying the asset to expiration, and we should subtract off any positive carry, that is anything that acts like a rebate to the price prior to expiration. All right, that's it for the review problems here. Remember that you're going to get a sheet of notes, actually double-sided, or you can use 2 single-sided pages of handwritten notes, and make sure to get all your formulas down for that to be prepared for the final. Okay, that's it.